All right, class, welcome. Today, we're going to dig into something really specific, but also really, really important in tax legislation. This is one of those rules you will definitely run into in your careers, so let's just jump right in. So, our topic today is loans to adult family members, but what we're really focusing on is a very specific tax rule called an attribution rule. You can think of it as a countermove by the government to shut down a pretty common tax planning strategy. This is what we call a classic anti-avoidance rule. And understanding how it works, well, it's absolutely crucial. And really, it all boils down to this question. It's a question you're going to get from clients all the time. Hey, is it a smart idea to loan money to my kid in university? Can we save on taxes that way? And, on the surface, it sounds pretty logical, doesn't it? But as we're about to find out, the tax law has a very direct and very specific answer to that question. Okay, so here's our roadmap for today. First, we'll talk about the strategy itself, this whole idea of income splitting. Then, we'll dive right into the attribution rule that was built to stop it. After that, we'll walk through a case study to see it in action, and this is super important, we'll also explore the exceptions, when the rule doesn't apply. And we'll finish up with the key takeaways you absolutely have to know. So let's start with this income splitting puzzle. Let's set the stage. Imagine you've got a parent who's in a high tax bracket. They want to help their child get through university, and they've got some extra cash to invest. But they're already paying a lot in taxes. Their child, on the other hand, is a student with practically no income. And that's when a light bulb goes on. And this is the goal. The parent has this idea. Wait a second, what if I just loan the money to my daughter? She can invest it, earn some income, and because she's in such a low tax bracket, she'll pay almost no tax on it. The family saves money overall. And that, right there, is the core of income splitting. It's all about moving income from a high tax pocket to a low tax pocket. But as you can probably guess, the government isn't just going to sit back and let this happen. They are well aware of this strategy, and so they've developed a very specific tool to stop it from working. Let's take a look at that tool, the attribution rule. So here it is. In simple terms, this rule says that if you make a loan, and one of the main reasons for doing it was to reduce your tax bill, any income that's earned from that loaned money gets attributed, or basically bounced straight back, to you, the lender. It's as if that income never left your hands for tax purposes. It completely undoes the income split you were trying to create. Now, here's where it gets really important for you as tax students. This rule is incredibly specific. It doesn't just apply anytime you lend money to family. For this rule to get triggered, all 4 of these conditions have to be met. First, it has to be a loan to a related adult, what the law calls a non-arm's length person. Second, the interest rate is a huge red flag. A 0% or super low interest rate screams that this isn't a normal loan. Third, and this is the big one, is intent. Was one of the main reasons for this loan to save on tax? And finally, the money has to be used to earn property income, like interest or dividends. Theory is one thing, but seeing it with actual numbers really makes it all click. So let's walk through a quick case study to see exactly how this attribution rule plays out in the real world. Okay, here's our scenario. A parent who's in a high tax bracket loans their 20-year-old student $50,000. The interest rate on the loan is 0. The student takes that money, invests it, and earns $3,000 in interest income. So the big question is, who pays the tax on that $3,000? And this table shows you the impact perfectly. The family's plan, the incorrect method, was for the student to report that income and pay very little, if any, tax. But remember our 4 conditions? They were all met. So the correct method applies. That $3,000 of interest income gets attributed right back to the parent and is taxed at their high marginal rate. The tax savings the family was hoping for? It just completely disappears. Okay, so we know when the rule hits. But just as important for any tax professional is knowing its boundaries. I mean, when does it not apply? Understanding these exceptions is absolutely key to giving good, solid advice. The first major exception is right there in the name. This is a rule about loans. The law is really specific on this. If the parent had just gifted the $50,000 to their adult child with no expectation of repayment, this rule would not apply. The income earned would be taxed in the child's hands. This distinction between a loan and a gift, it is absolutely critical. The second key exception comes down to how the money is used. Remember that 4th condition? The money has to be used to produce income.
So if the student used that same $50,000 interest-free loan to pay their tuition, or maybe to buy a car to get to class, well, those things don't generate income, do they? So the attribution rule isn't triggered. There's simply no income to attribute back.
All right, let's bring this all together. If you only remember a few things from today, these are the core concepts you need to take away. These are the things you'll need for your exams and for your future work. Okay, let's recap the big points. 1. This is a specific anti-avoidance rule aimed squarely at income splitting with adult family members. 2. Remember the major exceptions. It only applies to loans, not to gifts. 3. It only applies when that loan is used to produce income. And 4. The lender's intent is crucial. That purpose test, the idea that a main reason for the loan was to cut taxes, is a central part of this rule.
And I'll just leave you with this question to think about. This rule shows us that tax law isn't just about numbers, it's about purpose and intent. When you read a phrase in the Income Tax Act like one of the main reasons, that's a huge signal that the law wants you to look beyond the mechanics of a transaction and ask, why did they do this? As you move forward in your careers, learning to think about the purpose behind the rules, well, that's what's going to make you a truly effective and insightful tax professional. That's all for today.